Gentleman reserves. The gentlelady from California is recognized.
Thank you very much. As we consider whether we should make the approval of bank mergers easier, I have another example of how mergers have led to major problems. In 2020, the Federal Reserve and the OCC fined Citigroup $400 million over serious ongoing deficiencies relating to its risk management systems. Now, this is very, very important. Every bank must have risk management, but when they get too huge, not only do they not have the proper risk management, it doesn't work very well. It was a long-standing issue that Citi had after they went through a series of mergers in the 1990s. When the 2020 fine of $400 million was imposed, now there was an article in the Wall Street Journal that explained how mergers harm the bank. They wrote, and I quote, "Regulators have long fretted that the hodgepodge of systems, a legacy of a string of deals in the 1990s that turned Citigroup into a financial powerhouse, could make the bank vulnerable to costly and potentially damaging missteps, too big to manage. A recent high-profile error, Citigroup's accidental $900 million payment to creditors of cosmetics company Revlon, gave credence to their concerns," quote, end quote. That's right. The bank lacked sufficient controls because of its past mergers, too big to manage, and accidentally paid $900 million to Revlon, which quickly went into litigation. But the bank did not correct their problems. Regulators fined them again last year, but earlier this year, we learned that Citibank made another big payment error. The bank, I love this one, the bank intended to pay a customer $280, but somehow accidentally added way too many zeros to the transaction. For 90 minutes before an employee caught the mistake, one lucky customer had $81 trillion credited to their account. Woo! Unfortunately, for that customer, the bank corrected their error. And far too often, these kind of mismanagement mistakes actually lead to harm for consumers. In fact, since 2000, Citigroup has paid over, listen at this, $27 billion in fines, settlements, and consumer remediation, including 42 actions related to consumer protection violations. This includes discriminating against Armenian American credit card applicants, overcharging other credit card holders, and mortgage servicing violations that could have helped homeowners avoid failure. So again, this is the logical conclusion. If we have faster mergers, we will have fewer and fewer banks that are bigger and bigger and indeed too big to manage. And so let me just say that when I said how much they had been fined just a moment ago, Citigroup, one could think, how could they be fined that much money? How can they afford it? Where do you think they got that money from? Where do you think that money came from? Why do you think that doesn't matter to the big banks? It's just a matter of doing business. You know where that money comes from? It comes from the customers. That's why we have to make sure that the customers are serviced properly, that when a big merger wants to have support from the government, that they will have been vetted in such a way that OCC and understands very well how you're going to service these customers. Are you going to close down these branch bankers? How are you going to help somebody that's looking for a mortgage? What are you going to do to the person that can't talk to the ATM because they're trying to get a car loan? And so these are legitimate questions. These are legitimate answers that need to be given. And so I want to just say this. The money does not fall out of the sky that allows them to pay millions and millions of dollars in fines. It comes from charging the customers, increasing interest rates, laying off employees so you have less employees to pay, and the services get worse and worse and worse. The customers are the victims of these big mergers who do not want to be reviewed properly and who you support in not wanting to be reviewed properly. I reserve the balance of my time.